Is your option trade losing money? Don't panic. Every trader has losing trades. What separates the consistent winners is knowing when to roll, adjust, or close the position. In this video, I'm going to take out the guesswork and I'm going to give you clear strategies to trade smarter. Trading losing options can trigger fear and anxiety, making it hard to think clearly and manage positions effectively. Many traders hold on to losing trades too long, hoping they'll turn, and they panic or exit prematurely, causing costly mistakes. Managing losing trades properly is crucial to protect your capital and improve long-term results. So why do trades lose money? Well, option trades lose money for several common reasons. Often traders enter positions without fully understanding how the option pricing works, how time decay affects the value of the option, and how implied volatility works. Losing trades can result when the underlying asset fails to move as expected, or if the option premium erodes too quickly as expiration approaches. Emotional trading, such as chasing losses or panic selling, also leads to poor decisions that amplify losses. Additionally, over-leveraging or taking too many risky trades without proper risk management sets traders up for complete failure. Market volatility and unexpected events can further cause positions to underperform, making it critical to identify when and how to adjust losing trades instead of just holding them blindly. When should you consider rolling a trade? Well, rolling an option trade means you're closing your current position and simultaneously opening a new one with a later expiration date and sometimes a different strike price. This strategy lets you extend the duration of a trade, adjust risk, or lock in gains without fully exiting the position. You should consider rolling when your position is losing or near expiration, but you believe the underlying asset still has potential. For example, if a call option is underwater, rolling it up to a higher strike price and further expiration date can reduce your risk and bring in additional credit. Similarly, rolling down a put option or rolling out a savior trade more time to move favorably while managing risk. Rolling helps maintain exposure while adapting to market changes and conditions. So how do you adjust a losing option trade? Well, we're going to show 3 different examples here coming up. But first, let me explain. Adjusting a losing option trade means modifying your position to improve its potential or reduce risk. This can involve adding additional option legs, changing strike prices, or converting the trade into a totally different strategy. Adjustments give you a chance to reprice risk, capture more premium, or extend the trade duration, increasing your chance to profit. When do you close a losing trade? Well, knowing when to close a losing options trade is critical for protecting your capital. Some traders use a rule of closing when the trade hits a predetermined loss level, such as 30 to 50% of the premium if you're a buyer, or when a spread loses 70 to 80% of its credit. Another key signal is if the underlying asset breaks important technical levels and invalidate the trade thesis. Now that's the key. I know what my stocks that I trade are truly valued at, what they should be valued at based on the earnings, based on the growth, the net income, the current price to P to E ratio. So if it drops and I still see huge growth ahead and the PE level is super low, that's a stock on sale. So I'm not going to close that trade. I'm going to stay long in that case. So I really don't close a trade until my thesis, my underlying thesis changes. If there's a change in management or a change in their thinking and investment approach, then I'll reconsider and look at things differently. If there's a big drop in their growth for a reason that I don't see going away right away, this is where reading the earnings reports and following their quarterly reports and numbers quarter after quarter really makes the difference. You got to know your stocks. All right, guys, we're going to look at adjusting 2 positions right now. The first one is Shop. We're on the Tasty Trade trading platform and brokerage. There's a link down below, my favorite for trading options. There's benefits if you go through my link, so check it out. All right, Shop. You can see I've got an iron condor on the 125, 135 put credit spread, and 160, 170 call credit spread. And you can see we're up $79 on this trade right now. We're trading, if you go to curve mode here, this is what I love about the platform, analysis, and then you can see here, we are right in the middle. We're trading right now at 149, so you can see 149. And then I've got my put credit spread and my call credit spread. And this is the max loss over here and down here. But we're kind of right in the middle of the trading range. And we've got, let's see, 16 days to expiration. So we're still in October right now. And look at all the premium. We've got 222 left still to collect. So I might typically just leave it and let this premium come in a little bit further. But what I'm going to do for the sake of this video, I'm going to go ahead and roll to the next month. So we'll roll the put credit spread first, 125. So we're going to click on that, left click, and then I'm going to right click and then roll expirations out to November. You know what? Before, let me show you my target price for for SHOP right now. It's trading at 149 right now, but if you look right here on the Yahoo Finance, you can see the 5-year chart, and you can see it's up here at 149. They've got a target of 162. My target is right around that price as well. So I like it right where it's at right now. So I want to roll to another iron condor because I see it trading within this range, and this is where I find it fairly valued right now. So that's what I'm looking to do. Now, if you look at the analysis, they beat earnings last time and missed the time before that, but their growth estimate is 27, so double digit, high 20s. Growth estimate for next year. And if we go to the stats page, there's some numbers that I pull off the stats, and you can see, take a look right here. You can see the price to earnings, 77, so it's high. But it's a tech stock, and it's highly valued, and it's going to do well going forward. E-commerce, they're dominating right now, Shopify. But if you look at the net income statement, the revenue of $10.01 billion and net income of 2.34, you can go into my option calculator here, the price target calculator, and you can see the fair value right now, 163. So that's where I get my target from. I look at this and then I kind of adjust based on other factors, such as this takes into account the trailing 12-month current revenue, the net income, and I pulled this right off Yahoo Finance, and then the PE of 70, and then a growth rate of 25%, and a net income growth rate of 30%, and then it comes up and it calculates year 1, year 2, 3 years out, your target price, where it should be priced at. So that's where I come up with my levels. Just put price calculator if you want to get a copy of this price calculator. It's great, and it's how I value stocks. But put that in the comments, and I'll send you the link. So that's Shopify. Now let's go back to the trading platform, and we're gonna, like I said, left click, and then we're gonna right click, and we're gonna roll to November. And should I keep it right at 135, 125? That's pretty safe. We're right there at 150. We can collect $1.95, which is nice. I like to collect a third the width of the strike. So we're going $10 wide, but I'm going to do both sides. So I'm going to collect a little bit less than that. But I am a little bit bullish, so I'm going to keep it at 135, and I'm going to roll out to November, review and send. And come on. Okay, it placed the trade. Let's go back over here. We're going to have to adjust it down a little bit. 193. Just to get filled, let's get this thing at 190. Make sure we get filled. It's going to fill at the best price it can. Okay, it filled it at 190. All right. So we just rolled the put credit spread from October to November, and we collected $1.90. So One contract controls 100 shares of stock, so that is $190. Now we're going to do the same on the call side, the 160, 170, left click, right click here, roll expiration out to November, and we can collect $150. So again, I like that. If we go out a little bit further, how much are we going to collect? $1. Nope. That's the one I like right there. So let's go 150. We'll collect a $1.50 on this one. Let's see if we get filled here. If not, I'm going to just adjust it down a little. Right click, replace. We'll go down to 145. There we go. All right, well, we're filled. We're rolled now. We've got the 135, 160. So the same positions that we had on in October, we just rolled out to November, and we collected additional premium. And you can go curve mode, analysis, and you can see we're right in the middle of that trading range. So I really like that for Shopify going forward. Now, the next one I want to look at is UNH, United Healthcare. It's way down, 344. You can look at the chart, ugly. But here's the thing with United Healthcare. It is a stalwart. We're at 16 days to expiration. I've got 2 put credit spreads on, 330, 320. So they still are in the green profit zone right now. And I've got, look at how much. We've got 410 left to collect in extrinsic. So with 16 days. And do they have earnings coming up? 1028. Yeah, so that's why. So we could look to roll these. Again, we could left click, and then right click, and we could roll out to November and leave them on and collect $1.62. And here is my case for UNH. Let's look again at the Yahoo Finance, and you can see it's way down. So unfortunately, their CEO was shot. We know about that. They've got a replacement CEO in, but they're so undervalued right now. They've got their 1-year target at 340 for UNH. Mine is much higher than that. We're going to go to my evaluator. My target's 478. So based upon their revenue and net income, a forward PE of 18 and just 12% revenue growth and 15% net income growth, we get a price of 478. So my target really is about 450 for UNH, but that's well below here. So we could roll right now, or we could wait and see. After 1028, there's going to be a volatility crush, and that premium is going to come in. And you can see right now we've got 422 in extrinsic. So you know what? Rather than roll this, I'm going to leave this on, and I'm going to add one more position because I'm that confident, because I know the values and the numbers. Now, so I'm going to go to November, and I'm going to put on a new position. And let's look at 310, 300. We can collect 218. 320, 310. We can collect 285. I kind of like that. How much do we collect at 330, 320, 360? So I like this because we can still collect. We're at the 29 delta, so we've got a 70%, 67% probability of profit. We can collect almost $3, 288. So boom, boom. It's not feeling it. All right. Right click, replace. We'll adjust down a little. 285. All right, I'm going to wait and let it get filled. Probably take sometimes it takes a few minutes, but I don't want to do that. I'll go down as far as 280. That's how much I like it. There we go. We got filled at 283. All right, guys. To recap, there's 3 things that you can do with a losing option trade. You can roll, you can adjust, or you can close out the position completely. And based upon your target price and where you believe the stock should be, that's how you make your decision. So remember to leave a comment down below. Let me know what you're trading. Any questions that you have, I answer every one. Be sure to like and subscribe, and check out the free options workshop as well as the paid course. If you like this video, Watch this next one.